Here's a question that might feel a little uncomfortable. What if one of the habits you were taught to be proud of, saving money, is actually working against you? Not in some dramatic, catastrophic way. Quietly, slowly, year after year, without you noticing. Most of us grew up hearing the same message: spend less, save more, put money in the bank, be responsible. And that advice isn't wrong exactly, but it's incomplete in a way that costs people real money over time. Because saving money and growing money are not the same thing. And if you've been treating your savings account like a finish line, there's a good chance inflation has been running in the opposite direction this whole time, and winning. Today, let's break down why that is, what's actually happening to your saved money every year, and what the alternative looks like. Welcome to Slowfolio, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Everything you hear here is purely for education, not a recommendation to buy, sell, or do anything specific with your money. All right, so let's start with the thing that makes this whole conversation necessary: inflation. Think of inflation like a slow leak in a tire. Your tire looks fine, the car feels normal, but every single day, a tiny bit of air is escaping. And if you don't add more air to compensate, eventually you're driving on a flat. Money works the same way. The purchasing power of your money, what it can actually buy, decreases a little bit every year because the prices of goods and services tend to rise over time. That process is inflation, so here's the uncomfortable math. If inflation runs at around 3% per year on average, which is a fairly typical, long-run figure in many economies, then something that costs $100 today will cost roughly $103 next year, $106 the year after, and so on. The money in your wallet hasn't changed, but what it can buy has quietly shrunk. Now here's where saving money becomes a problem, not a solution. The average savings account at a traditional bank pays somewhere between 0.5% and 2% interest per year. If inflation is running at 3% and your savings account is paying 1%, your money is technically growing in number. But in terms of real purchasing power, what that money can actually do in the world, it's shrinking by about 2% every year. You're not standing still, you're moving backwards. That's what people mean when they say saving money is making you poorer. Not poorer in absolute numbers, but poorer in the only way that ultimately matters: what your money can buy when you actually need it. Now let's talk about why most people never notice this happening, because it's not obvious and it's not designed to feel urgent. The reason this slow erosion stays invisible is that your bank statement always shows a number that's either the same or slightly higher than last month. Nobody sends you a letter that says your purchasing power declined 2.1% this year. The number in your account goes up, even if the real value goes down. And because we're wired to think in nominal terms, the actual digits on the screen, the loss doesn't register emotionally the way it should. Think of it like this. Imagine you had a jar of cookies on your counter, and every night while you slept, someone replaced one cookie with a slightly smaller cookie. Same number of cookies in the jar every morning, but over time, each cookie is just a little bit less than it used to be. You'd never notice day to day. But after a few years, the cookies are dramatically smaller than when you started, and you'd have no idea why you never felt quite as full. That's inflation working on your savings. The number stays the same or grows slightly, but the real size of each unit is shrinking quietly every night. This is also why the advice, just save more, doesn't actually solve the problem. Saving more money in an account that earns less than inflation doesn't close the gap. It just means you're losing purchasing power on a larger amount. The leak is still there. You've just got a bigger tire. So if saving alone doesn't work, what's the alternative? And this is where a lot of people hit a mental wall because the word investing still sounds complicated, risky, reserved for people who know things they don't. But here's the twist. The real risk for most people with a long time horizon isn't investing. It's not investing. Keeping money in cash or a low-yield savings account for decades isn't the safe option. It just feels like the safe option because the number in your account never visibly drops. When you invest money in a broad, diversified way, like through an index fund, you're buying a small ownership stake in a large collection of businesses. Businesses, over time, tend to grow and create value. When they do, your ownership stake grows too. Historically, broad stock market indexes have returned around 7% to 10% per year on average over long periods. That's not guaranteed. Markets go up and down, sometimes dramatically, but over decades, the long-run direction has consistently been upward. Compare that to 1% in a savings account against 3% inflation. The difference isn't just a few percentage points on a spreadsheet. It's the difference between your money working for you and your money slowly dissolving. To be fair, investing carries real risk that savings accounts don't. In any given year, markets can drop 20%, 30%, even more. If you invest money you need in 6 months and the market drops, you could be in serious trouble. Savings accounts aren't useless. They serve a specific and important purpose. The point isn't to avoid savings entirely, it's to understand what savings accounts are actually good at and what job they're not built for. So let's talk about what savings are actually for and where investing fits in around them. The classic framework is the emergency fund. 3 to 6 months of living expenses in a liquid, accessible account. This money isn't meant to grow. It's meant to be there, to protect you from having to sell investments at a bad time, take on debt, or make panicked financial decisions when life surprises you. Beyond the emergency fund, the calculus changes. Money you don't need for the next 5 to 10 years, retirement savings, long-term wealth building, that money, sitting in a savings account, is being eroded by inflation year after year. Every year it sits in a low-yield account is a year it's not compounding in the market. Compounding is the key mechanism here. It's returns generating their own returns, accelerating the longer it runs. The earlier you start, the more decades compounding has to work. Every year you delay, you lose not just that year's returns, you lose all the future compounding that would have grown from those returns. That's the real cost of waiting. Let's make this concrete with 2 people, Felix and Rosie. Both are 25 years old. Both have $10,000 to put away and plan to leave it untouched until they're 60, a 35-year horizon. The only difference is where they put it. Felix keeps his $10,000 in a traditional savings account, earning 1% per year. After 35 years, his balance has grown to approximately $14,166. In nominal terms, that's a gain. But after accounting for 3% average annual inflation, the real purchasing power of that $14,166 is actually less than what $10,000 could buy when he started. Felix lost money in real terms, even though his account balance went up. Rosie puts the same $10,000 into a low-cost, diversified index fund and leaves it alone for 35 years. Assuming a 7% average annual return, conservative by historical standards, her $10,000 grows to approximately $106,000. More than 10 times what she started with. And because 7% comfortably outpaces 3% inflation, her real purchasing power has genuinely multiplied. Same starting amount, same time horizon, same level of effort, neither of them touch the money. The only difference is where the money lived for 35 years. Rosie's journey wasn't smooth. There were years her portfolio dropped significantly, years where Felix's stable savings account probably looked more appealing. But because she didn't need the money for 35 years, short-term volatility was noise, not signal. And the long-run outcome reflects that. So what does all of this actually mean for you? First, keep your emergency fund. 3 to 6 months of living expenses in a liquid, accessible account is not wasted money. It's protection. It's what lets you stay invested during downturns without being forced to sell at the worst time. Second, for money beyond your emergency fund, money you genuinely won't need for 5 or more years, the data makes a strong case for putting it somewhere that can beat inflation over time. A simple, low-cost index fund is the kind of boring, consistent tool that has historically done that job well for long-term investors. And third, start noticing the difference between nominal and real returns. When your savings account says you earned 1.5% this year, ask what inflation was running at. If the answer is 3%, you didn't gain 1.5%, you lost about 1.5% of your real purchasing power. That reframe changes how you see your money, and it's the shift most people never make because nobody teaches it to them. The truth is, saving is a virtue. But saving without investing is a habit that feels safe while quietly costing you more than almost any bad purchase decision ever could. It's not about spending more or taking reckless risks. It's about making sure the money you've worked hard to set aside is actually working just as hard in return. If you found this helpful, please like and subscribe to keep growing the Slowfolio community. Thanks for watching and see you very soon. Bye.